Good morning, real estate investors, and welcome to the only podcast that is 100% committed to helping you set yourself free through real estate investing. I'm Scott Jelinek, the founder of the Master Investor Academy and author of my brand new book called The Art of the Slow Flip. For anybody who has not got a copy of The Art of the Slow Flip yet, you can get a free copy at slowflip.com. That's slowflip.com. So today we have a guest on, and I want to tell you before I start speaking to him why I think this is going to be interesting. So for those of you who have been listening to me and following me for a while now, you know the big basis of our business doing slow flips is we sell properties with owner financing, right? We buy with short term, we sell with long term, and we operate like a bank, which is kind of the whole premise of our business. So today's guest, his whole thing, his program is Think Like a Bank, which is why I am so curious to hear exactly what you have going on. So welcome, Sarry, Ibrahim, and welcome to the show. How are you doing today?
Hey, Scott, thank you so much for having me on your podcast. I appreciate it.
Thank you for being here. So I love your title of, I think you have a podcast, right? It's called Think Like a Bank. I love the title of your podcast and your program. And the reason I love it so much, and you may or may not know exactly what we do, but when I teach slow flips, I actually teach, the mindset of the big banks. And I always say, we run around and we do all this work, we collect this money, and then we send it up to the bank. And in the slow flip model, we've switched that on our head where we're the bank and people are running around and sending us their money. And you've taken it a step further with your Think Like a Bank program. And so I want to hear exactly what that is. But first, if you don't mind, tell us a little bit about yourself and how you got here.
Yeah, definitely. Thank you for that. So I'm from Chicago, Illinois, born and raised here. I started this journey, the financial services journey, about 8 years ago. Started a company called Financial Asset Protection. So it's a full service financial services firm. We help real estate investors, business owners with all types of financial strategies, like saving for retirement, becoming their own bank, you name it, and pretty much anything to solve financial problems we help with. And then, as you mentioned, we have a podcast called Thinking Like a Bank. And that's kind of the brand that I'm building. I'm building on this brand of, instead of you being the real estate investor or the business owner, also be the bank in that situation. So that's what I want to talk about in this podcast. And I'm looking forward to jumping into that.
I can't wait to hear exactly what you do, because that is what we do. We operate like a bank. And so I want to hear your take on it and how I'm shaking things now. So tell us about how your program works and what exactly is it.
Yeah, so it's the bank on yourself strategy, which a lot of real estate investors know it as infinite banking, and what it is, it's using a special type of life insurance, high cash value life insurance, for you to become your own source of financing. So let's just say, for example, you have a property, right? And let's just say you have enough cash, you've built up cash in your whole life policy over the years. Instead of going to a bank to finance it, you can go to your policy, you can take out a loan from the insurance company against your policy, and then you can buy this property now. So that's I guess a basic way of doing it. You could also use it in alongside other bank financing. So let's just say you need 25% down. You could borrow from your policy the 25% and then get the other 75% from the bank. So now you're like almost 100% leverage, but 25% of that's coming from your own policy. That's what we help clients with. We help them identify what kind of policies they need, how they're going to structure them, where they're going to get the funds to structure them, how long they're going to fund the policies for, how often they're going to take out policy loans, the servicing of those loans. If they need to invest in real estate, we have a couple different avenues for them to invest in as limited partners. So yeah, that's what we do. We help them use the special type of cash value life insurance for them to be their own sources of financing.
So I actually have this already set up. I've been doing this for a while, but I haven't used it. I did use it once. I did a loan from it when I bought my primary that I'm in, but I've never used it for investment. I mean, I think I have like 300,000 in there right now, right? Yeah. And I did pull it out when I was purchasing my home because I paid cash for it, even though there was a loan from the insurance. My rate was really low, and that's one of the things I like, because I think, and I could be wrong, and you correct me if I think my rate was like 3%. It was a ridiculously low rate, and I didn't have to do anything because it was pretty much I just had my own checkbook and just write my own check for it. So I didn't have to apply or do anything because it was secured against the cash. So I'm guessing what I have is what you're talking about. That's what you do and teach, correct?
Exactly. Yeah. It sounds like you had your life policy, and then you may have had an affiliation with a third party bank, and then the bank lets
Yep.
you write a check, and then when you
Yep.
write that
There was
check,
a company they set it up with, and I don't know if it's okay to say the name. I think it's Bancor, I think it was called.
yeah,
Is
I know
that
who you're talking about. Yeah. So
and
yeah, they have like a
so
checkbook access. Mhm.
yes, so I have multiple different policies, and so we did them all together and got one. I don't know, would you call it a line of credit? I guess against our cash value, and that's what we used. So it's interesting. I hadn't thought about that for investing. I did it when I bought my
Yeah.
primary. I hadn't thought about that for investing.
Yeah, absolutely. Yeah. And well, the good thing about it is when you do it for investing, let's just say you are gonna use traditional financing and you need 25% down. Well, the bank isn't gonna look at that loan that you took out either from the insurance company or from a third party bank,
'Cause
like
it's
in
already
this
your own
situation.
money, right?
It's
Yeah.
your own money, yeah, and it's a non-recourse loan that doesn't require any payback. So they won't count that as other types of debt. They won't consider that in the debt to income ratio. So it's really cool because it can unlock more liquidity for even more financing.
So let's go back to the beginning. How did you get started doing this?
Yeah, this all started after reading the book. What's called The Bank on Yourself Revolution by Pamela Yellen. So the book talks about the strategy of becoming your own source of financing for you to skip Wall Street, grow your money predictably. So I bought into the concept, as a client. So I got into this as a client, as a customer. I bought into this. I believe in the system. I own these policies personally. My wife has a policy. Our close family members have policies. So this was something that was kind of at our core, right? Like something that almost a lifestyle we wanted to live by. And then after that, since I had already been in the insurance and financial services industry, I'm already licensed. I figured I'll add this to my tool belt. I'll add this product or this concept to my tool belt so I can help other clients in the same situation. Since I understand this, as a client, and then it led to, well, since this is we started getting busier, right? We started doing a lot more podcasts. This is probably my 350th podcast appearance as a guest
Wow.
speaker. Plus, we've done over 100 podcasts on our podcast. So a lot of people started reaching out, and we're helping a lot more clients now. So this is what I do now full time. About 90% of my focus now is just whole life insurance, high cash value whole life insurance for real estate investors and business owners. 10% of it is other types of insurance like term insurance, Medicare, health insurance. But the most of my focus now is just on this concept and helping people become their own sources of financing. And not only the source of financing part, but also helping people really build cash in the future in a predictable way, in a way that Wall Street really can't do. I'm not completely against like stocks and bonds and mutual funds. I think it's better to invest in stocks and bonds and mutual funds than it is to not invest at all. I think you can get some alpha there or some growth there, but you can't rely on that, right? And I think this is a big problem, is that Wall Street teaches us just get a job and then invest in 401, max out your 401k, get an IRA, get a brokerage account, max them all out, put as much as you can in there, and then just do like S&P 500, Vanguard, do ETFs, do just as long as possible, and it's not feasible for a lot of people, right? Like me personally, I didn't want to wait until I'm 70 years old to have $2 million in my mutual fund. That's irrelevant. Whether it's 2 million or 4 million or 6 million when I'm at 70 it's not going to make a difference for me now. So I wanted to kind of implement different strategies that could, because I am self-employed right now, to keep me self-employed, right? To keep me self-employed, and then to help other clients in that same situation.
So I'm thinking back a couple different scenarios. So I like this, and it's funny because some people you listen to hate this, and I'm sure
Yeah.
you've heard. I'm sure you've gotten plenty of hate, and I've heard, and I have it. So I have the argument sometimes with people who hate it, and they'll tell you all the different reasons: buy the cheapest, and then invest the difference, and go with all that stuff. But what I found now, I've been doing it for a while, and it wasn't this way in the beginning. But I just
Yeah.
recently looked at one of my statements, and I am getting a higher amount of cash value every year than I'm paying in. And so I don't really even understand. I mean, I guess it's because of the interest on what's already in there. Is that how that's working? Because I looked at
Yeah.
my cash value increase and it was bigger than the amount I actually put in this year. So I was like, oh, well, then why wouldn't I do it? It's kind of like forces me. It's an extra add-on savings. I pay about $2,000 a month, but I was getting more than $24,000 a year in cash value increase.
Yeah, it sounds like the policy is from a mutually owned insurance company, so they're crediting your account with dividends every year. So what's happening is because you have so much cash value previously, now when you put in more cash value on top of it, like you said, $2,000 a month or a year, when you add that in, it's buying up like 10 times more cash value every year because of the growth in the previous years. And then when you add more cash value, your dividends grow, the amount of compound interest you get in the policy grows, and then that grows a cash value, and so on. So it creates this compounding effect. I think that's probably the best thing about these policies is that in the later years, when you have enough cash value, every dollar you add, I mean, it gets to the point where everything changes really. Like in the beginning, clients are kind of like, well, what's the least of what I could do? And then when they start getting the growth, they go beyond the break even point. Then the whole conversation changes now. Now it's what's the max I can add into these policies? Because at some point, every dollar you put in is going to be 2 times, 3 times, 4 times the amount of cash value in there. It becomes better than the stock market, better than other types of investments. And then not only that, but it doesn't stop there, right? It can be used for other investments. Now you can leverage, you can borrow against it. You could buy real estate as an active investor or as a passive investor. You could get into different types of alternative investments. You could buy stock. You could do anything you want with that money. There are no restrictions, which is also a really good thing too to consider. Like another way that a lot of people invest in real estate is through their IRAs, and I do like that to a certain point. I like that model, but the problem is that there's a lot of rules behind using IRAs for real estate. It has to be entirely passive to you, right? Like you have to hire a property management company, or it has to be in a syndication or a fund, something completely passive to you. You can't be actively engaged in that real estate transaction at all. And if you are, then all your entire investment gets converted into a withdrawal, and there could be early penalties if you're under 59 and a half years old. So there's a lot of red tape around IRAs for real estate and other alternative investments. So I like this model, the infinite banking model, because you take out a loan from the policy, you can go on vacation with that money. You can remodel your house.
I don't recommend that, but you can, right?
Right.
So I'm going to tell you something funny. You're going to laugh at me now on how I got started with all these policies, because I have a bunch of them. And again, I like it now because I look at my statements and I'm like, it seems like it worked out. But let me tell you how I got started with them. And this probably goes back to 2009, 2010. I wholesale houses, and a guy I was wholesaling houses to was in the business like you're in. And so he would buy a house from me and I would make X amount of money. And then he would be like, talk to me about buying it. And it got to a point where I was just like, okay, yeah, you bought another house from me, I'll buy another policy. The only difference was I'd buy these policies and I got to pay for them every month. But in the end, I got a bunch now on myself and my wife and my son. And in the end, I love them because again, I'm getting more every year cash value than what I'm paying into it. So it turned out to be fantastic. Now, let me ask you, barring that you were selling houses and you felt an obligation to somebody to give them something back, how do you recommend people getting started? Do you recommend them doing like I did where it's a monthly plan, or do you recommend them starting with a lump sum, or how do you recommend people getting started with this?
Yeah, awesome question. It depends. I think that if they're looking for long term, like they're looking to fund something over the next 20 or 30 years, I'd probably recommend they do like 5% of their gross annual income into one of these policies or multiple policies. So they make like $100,000 a year, maybe 5,000 a year. On the higher end, maybe 10%, so like 10,000 a year in this example, could go into the policy over a long run. And if they also come across lump sums, let's just say they exited a real estate deal, they have like $200,000 in cash. Instead of that sitting in the bank, you can have it sit in a life policy that'll earn you probably. I mean, now I would say it would be higher than what banks are paying, but right now banks are kind of like they have all these promotions. Right. Like 4.8, 4.9%. But the thing to be wary of, it's temporary. It's 100% temporary, right? Because for the longest period of time, savings accounts and CDs were like 0.5% or 0.25%, and very recently, because of the interest rate increase, they've gone up. But if you look at the terms for CDs and money market mutual funds and these high interest savings accounts, they'll say like may last for 6 months or may last for a year. It's not like a long-term strategy. So if you are looking for a long-term strategy for that money, I would put that lump sum into a life policy that you just buy up one payment. You put it into the policy, it's paid up for life. It doesn't require any more ongoing payments. So I'd probably recommend a couple of different scenarios depending on the client's cash flow and their net worth.
So I have to follow you up with questions now, because you have me thinking about something that I was unaware of. I've always been making monthly payments, right? Yeah. Every month I make payments. You said, if you got 200,000 from a deal, you can just put it into in a life policy. Now, when you say put it into a life policy, you mean buy a new policy, correct?
Yes, exactly.
So now my big question is this, and you may not know the numbers off the top of your head. If I was to put 200,000 in right now today, how much of it is available for cash value for someone to withdraw or use for a deal or however they want it to do? Average, obviously you're not going to have a specific number.
Yeah. So I again, these are just going off the top of my head based off of recent cases I've worked on. They're not specific. They could be better or less for you. So if you put $200,000 in, your cash value within 30 days could be the cash surrender value, could be about $190,000. And then the amount you could take out a loan on is probably going to be $160,000 that you could borrow within 30 days. And then the death benefit, the life insurance amount is probably going to be $2 on the initial. So 400,000 maybe the death benefit. So yeah, so day one, you put $200,000 in, you could take out $160,000 within 30 days.
All right. That's not too
Yeah.
shabby. And then,
Yeah.
and you have $400,000 in life insurance.
Yes, exactly.
Okay. So I never looked into doing a lump sum amount, and that's interesting as a way to. And the other thing, and you didn't mention this, and this is something that I'm attracted to life insurance for.
Mhm.
So you tell me what I know or don't know if I'm ignorant to it. But life insurance is also, at least to the best of my knowledge, is also a completely protected asset, if I'm correct, right?
Yeah, it's protected from market volatility. It's protected from like stock market crashes, from real estate market crashes. It's also protected from.
I didn't mean that. I meant from creditors.
Yeah.
If as like asset protection,
Yeah.
as far as I've read, life insurance is protected from creditors. And actually, and you correct me if I'm wrong, I remember reading life insurance was one of the few things that was protected even against criminal, meaning if you did something and you were forfeiting all your assets, you got charged or whatever, the life insurance was protected. Am I correct in saying that?
Yeah, exactly. And yeah, I'm not an attorney, so talk to your attorney about this. But in most states, life insurance and annuities are protected, right? Because the way that states look at life insurance is you need it for your family, you need it for your estate, you need it for your children, your grandchildren. So for a creditor to take that, it could create a lot of like financial damage for your family. So that's the core of it. And same with like pensions and annuities. There's a lot of livelihood behind that for your family. So those types of assets are typically restricted. I think like probably, if I guess at the top of my head, maybe Florida is the best asset protection state. A lot of things in Florida are very protected, like your home that you live in, your pension, your annuities, life insurance. In my state, Illinois, there's a lot of protection around cash value life insurance or other types of life insurance. Some states have limits. Some states only have like $100,000 limit or something like that based on how much is protected. But talk to your attorney about that. I'd say that one of the ways that it's probably not going to be, it won't be protected if you like intentionally went to a lender, you borrowed from that lender, and then bought a life policy, and then defaulted on that loan.
Oh,
That
and then
probably
defaulted, and it was their asset. Really, you put into a thing, making it become your asset. That's interesting. Yeah. Well, that
Yeah.
shouldn't be protected. Yeah.
Yeah, exactly. Yeah, but to answer your question, yes. In most situations, life insurance is probably one of the best asset protection tools. That, alongside other things, your attorney. I talked to an estate planning attorney if I were you, or an asset protection attorney. They'll know a lot more than this about me. I just know the basics.
I remember reading about it way back, and I remember that it was one of the things they said was completely protected against
Yeah.
judgments, against bankruptcy, against anything. It was a protected thing that was completely separate from everything else, and I kind of like that. I have all kinds of asset protection in place for all. I own 178 houses. I have multiple businesses. I got all kinds of stuff, but then this was something that was separate, and I liked it that way, that it was completely protected and separate. So if somebody was getting started, now again, I started by signing some papers and doing it on a monthly. Well, I have multiple policies: 500 a month, 400 a month, 300 a month, all different policies. How do you recommend someone getting started? Is it a slow, long-term play like I did, or how do you recommend someone getting started?
Yeah, the first thing I'd recommend is understand the concept, get comfortable with it, listen to podcasts like this, read a couple books. I think the two top books on the subject are The Bank on Yourself Revolution by Pamela Yellen. That's one. And then Becoming Your Own Banker by Nelson Nash. Those are like the textbooks of this concept. So I'd read both of those books and then listen to podcasts, get very comfortable, do research. And then after that, I would reach out to an advisor who specializes only in this, not just somebody who has a life insurance license, like your brother-in-law or your auto insurance agent or somebody, or a financial advisor that does stocks. They're not going to really understand this concept. Reach out to somebody who does this full time. And then they should be doing a financial analysis meeting with you. So what that means is they're getting to know your financial situation. If somebody makes a recommendation to you based off the first call, they're probably not really, they're not familiar with your financial situation. So what we do with our clients is we do a full 1 hour financial analysis meeting, which is me asking questions about income, about net worth, about projected income in the future, about expenses, debt. I want to kind of understand everything financially about that person. And then we make a recommendation after that point that's going to be relevant to that client. Because if you're a 25-year-old school teacher who just started your career versus a 60-year-old real estate investor with 200 properties, you're going to have different needs, different wants, different time frames. It's all going to be different, right? So you need to understand the differences as the advisor. So I would look out for those top things, and then really, it's I always mention this. It's like Dan Sullivan's quote: "It's who, not how." Right?
Yeah.
When you implement this concept, it's not the life insurance company name. It's not the tool the advisor used, or what's the other tools they're using. It's the who. Like, who is the person that's helping you? They should have a track record of using this strategy with other real estate investors and business owners and full-time employees.
Is there a limit to how much somebody can have? Like, are you only allowed to have X amount of life insurance based on your income or net worth, or can you have any amount that you want to buy?
Technically speaking, there is no limit. There's no like federal limit for the amount of life insurance you can have. It's based off of either your income and or your net worth. So I guess an easy metric to follow is there's different age brackets too. So like if you're under 40, it's, I believe, 25 times your annual income. So if you make $100,000 a year, you take that, you multiply that by 25 times. So the most you can have in total life insurance from all life insurance companies is $2.5 million in death benefit. So that means you can have one company that's $2.5 million, or 50 companies that equal 2.5 million. So that's one way. And another way you could do it is you take your net worth. Let's just say your net worth is $5 million. You can get a life insurance policy for $5 million to cover your net worth. Or it could be a combination of those two, income and then your net worth. And then you could also do it for, let's just say you're 39 years old, you do the policies, everything, you meet that limit. And then let's just say you fast forward to age 45 now. Your income now is different, your net worth is different. You could then reassess it at that point. And again, it goes back to the who, right? The agent who's helping you do this. It's going to be their job to make sure that they get approved, that you get the best rating possible, because a lot of times underwriters and life insurance companies, they're very risk averse. It's very similar to when you go out and you get a mortgage or a business loan. It's going to take a while. You're going to get a lot of resistance, right? Because the bank wants to make sure the underwriter who's working on that is going to want to make sure there's no everything is legit. So same thing in life insurance, right? There's going to be a lot of resistance especially when you're reaching that 20-25 times annual limit. You're going to start seeing a lot of resistance. Policies are going to take longer to process. They're going to request more documents, more information, and the advisor is a good advisor will know how to navigate through that.
And so my last ones that I'm 50 this month.
Yeah.
To get new ones because I'm. Can you hear me?
Yeah, sorry, I kind of broke up a little bit. I heard something like 50. Something.
All right. I said, is it going to cost me more now because of my age, that I'm older?
It could, right? It could. However, the single premium policies are probably a good fit because the amount of life insurance you're buying up front, you won't see that big of a difference in age with the larger single premium cases. But of course, if you were doing like a smaller recurring monthly, then yeah, you probably see the cost of insurance greater in those. So yeah, it depends, right? It depends really. I think overall, just a general rule, it's probably better to get a life policy when you're younger because you get a lower rate. But it doesn't mean that if you're over 50, you can't get life insurance anymore. I've worked on policies for clients who are over 70 years old. So anything is possible.
All right. So last question. Well, one of the last two. If there's people out there, and one of them a big radio show who talks about how much he hates this program and he hates this stuff.
Yeah.
What do you say to those people that tell you all the reasons why this is the worst? Because I hear it too. People even make fun of that. I have them, and they're like, "Oh no, you should just get the cheapest insurance and invest the difference." And that's what a lot of people are pitching on their stuff. And I disagree with it, mind you. I'm on board with what you do. Yeah. But what's your answer to them? What are your answer to the people who say that?
Yeah, I mean, I'll give you the heads up, right? Like you go to Google, you search whole life insurance, you'll find more negative than positive about it. And it's because there's no such thing as like one type of whole life policy. There's 2,000 life insurance companies in the US, and each company has like 10 different products, and each product has 10 different ways to structure it. So there's a lot of variables that go into this play. You could do a policy that won't give you any rate, won't give you any return for 20 years. For 20 years, you put money into it, you won't be able to take money out of it for 20 years. And then there are other policies where you put money in, and within 30 days, you could take out 80% of your cash, of the premiums you put into, you could take out.
Wow.
So there's a huge spectrum, right? And I think it doesn't make sense to say that all whole life insurance is the same. Absolutely not. I think if you hear that, like if your advisor says that, or some other person, your accountant, they really don't understand what they're talking about, because it all depends. A client one time sent me an article saying, hey, there's all these negative things about whole life insurance. Is any of this stuff true? And it was like, one point was, the internal rate of return is less than 1% over the life of the policy. And I just took an illustration, and I took out a financial calculator, and I showed the client that it was like 3.9% or something, right? It was closer to 4%, the compound rate of return on the policy. So that just speeded that part right there about it being less than 1%. And the second part too was, why don't you just invest the difference in term and then the stock market? So what that means is, if you're going to do a whole life policy, instead of doing that, you do term, and then the difference of that you put in the stock market. Well, the problem with that is, term insurance is designed for if you pass away, not when you pass away. So that means that it's not meant to pay out. It's not designed to pay out. Actuarially speaking, it's designed for you to pay into it for the whole period of it, whether it's 10 years, 20 years.
And then live. Yeah.
And then live. Yeah, 99% of term life policies do not pay a death benefit. So you put in $100 a month for 30 years for $500,000 in coverage or whatever it is. As soon as that 30-year period is done, the insurance company will send you a bill for something probably 15 to 20 times what you were paying previously. So if it was $100 a month now, they'll send you a bill for $1,000 or $1,500 now a month, and it's going to be annual renewable term. So it's going to be $1,500 a month this year. Next year, it's going to be $5,000 a month. The third year, it's going to be $10,000 a month. It's going to go up to the point where 99% of people are going to tap out, and they're going to say, this is not even worth it anymore. You already lived. And then a lot of the pro Wall Street, Dave Ramsey, Susie Orman, they'll say that you want to build up enough financial assets, enough mutual funds and ETFs to the point where you have enough in reserves, so that way you don't need life insurance anymore. Like you will build up a portfolio. And I completely disagree with that. You don't know what it's going to do in the next 30 or 40 years, what your portfolio is going to do in the next 30 years. What if there's one crash and you're down 50% now? You don't have another 20 or 30 years to rejuvenate that back to where it was. So that's one aspect. And the other aspect of it too is, you want to leave life insurance for your beneficiaries and your kids and your grandkids. You want to, because you get a higher IRR that way. You get a higher rate of return. If you're leaving them life insurance, for every dollar you put into it, it could be 10 times that by the time you pass away. But if you're leaving them stocks, bonds, and mutual funds, it's not going to, for sure, it's not going to be 10 times that amount that from the day you started to the day you pass away. It's just highly unlikely for that to happen. So, and then there's a lot of tax advantages with leaving life insurance. So I urge you, look at more of the details. Don't just read any article that comes up on Google. Like, do more research, talk to more independent advisors, people who are not just one on one side or the other side, people who are more unbiased and can give you, and then do your own research, of course, as well.
Right. So I love it. So I'm going to let you go in a second, but I wanted to address one other thing. So for people who are my guys who do slow flips, this is something that potentially you might want to look at that can work with the slow flips. The people who are self-funding your slow flips, where maybe you could self-fund into this and then borrow against it to fund the slow flip, so that you still have this accruing interest simultaneously as you're paying back the loan from yourself from the slow flip when we purchase these properties. So that might be a great way to kind of double bang what we're already doing, be in the bank for our properties, be in the bank now as your private lender to yourself. So I kind of think that might be a great strategy. I'm going to look more into it myself. So Sarry, one last question is, so if somebody's thinking about doing this, curious about doing it, or wants to look deeper into it, and they wanted to speak to you, what is the best way for somebody to get in touch with you or to learn more about it?
Yeah, easiest way, you can go to thinkinglikeabank.com. It's thinkinglikeabank.com. You can schedule a call with me. I'd love to talk to you. We can run the numbers. We can go through a scenario, and we could see if it's gonna work mathematically. If it's gonna work, where you have your properties, you're leveraging, you have the slow flips, and you could actually get an arbitrage or more money on the money you're making already.
thinkinglikeabank.com.
Yes, correct.
Fantastic. All right. That's all I got for you today, Sarry. Thank you very much for coming on. I greatly appreciate it. I am going to dig deeper into this myself because this may actually work hand in hand with what we're already doing as far as funding our own deals. So I am looking forward to it. And I thank you for coming on.
Thanks, Scott. Appreciate it.